closer to that and at 3,000?
Oh, because, well, it's, well, the answer is,
That's what she meant. This question's for you.
so it's a number of different things. I think that if you look at the chart, it really starts to fall off in '99. And I think that what happened is that you had the dot-com crisis. But even before that, you had, I think the first nail in the coffin was decimalization, which killed the market makers, and it made it much less profitable for them to make markets in these stocks. And then you had Reg FD, and for a year or two, it, CEOs were just using it as an excuse not to talk to analysts, and they would just refer to public company filings. So that killed research in a lot of small cap companies, sell-side research. Sarbanes-Oxley was another nail in the coffin, and it made the cost of being public a lot more expensive. Private equity has become a much bigger, a much easier alternative for companies. Venture capital, that market has become a lot more mature over time and institutionalized. You have companies like Uber that don't need to go public. So it's kind of like, what? Well, they didn't need to go public, and they got to like 60 billion. Okay,
yeah, inside joke,
Airbnb, whatever. So, but there are, it's like I just saw Murder on the Orient. Oh, I can't spoil the movie for people. But there are a lot of culprits, and it's very complex.
The benefits of going public, I think, have been marginalized over time. It's more costly to be public. As a CEO, you have to sign off on financials where perhaps you miss something, you can go to jail for it, even if you didn't know about it and you're not a criminal. And then, benefits of going public is liquidity, access to capital, and there's more unicorns than there's ever been. So I think those have all probably been public in previous generation.
Go ahead.
Which of these methods of creating alpha do you think ultimately will be done better by a human than by a computer?
I think the challenge, repeat the question, is sort of the famous AI question is, where do we stand against AI?
It's man plus machine.
Yeah, I think it's going to end up being man plus machine. I'm in that camp. I think that machines are really good at pattern recognition, particularly big data, and they're going to crush us at that. But having the insight to what kind of questions to ask, I think with Noah's example is the right example. It's that spark. It's that, hey, wait a minute, knowing him alone, knowing what he's doing, I think the chessboard's going to look like this to him. If I can get ahead of that, I might be able to do that. That's not a pattern that repeats. That's not an AI problem. That's not a machine learning. That's not a neural net. That's that spark. So I think it's that notion of, you cannot read the newspaper, although Michael Price can read the newspaper and beat us all, but it's hard to read the newspaper and get an edge. You shouldn't be thinking about it. You've got to start thinking 2-3 steps ahead as the pieces are starting to move. And those are patterns that aren't repeating. And maybe they repeat in a sense. As Noah said, he went back and he looked at a lot of turnarounds to see what characteristics, but everyone's a little different. Neural nets are fantastic at things that repeat, but you need a lot of data to make it work. And the data's not...
in this situation, it never, like history doesn't repeat itself, but it rhymes. So that's the problem, is it's never the same type of situation. So again, this man plus machine, because I think the machines allow us access to these data sets that were never before available. But somebody's got to figure out what data is relevant and what data isn't, and then they have to make sense of that data, and machines aren't there yet.
Yeah, I mean, I probably shouldn't say this as a Columbia alum, but I think any strategy based on valuation these days is possibly the worst strategy you could pursue. And I'll explain why. Because in the days in which Benjamin Graham was succeeding and outperforming the market, nobody knew what the multiples of stocks were. Nobody even had access to the financials. Now we're in the complete opposite, where everyone knows the valuation of every stock, but nobody knows what the earnings power will look like. So I think that multiples are super efficient these days, and so it's, and another way to explain it, valuation is a condition, it's not a catalyst. So what you need to do is do the fundamental work, and it's almost like come full circle. Well, if you can get an edge on the business fundamentals, that's how will systematically beat the market, where everyone else is just trying to buy a cheap stock. Go ahead.
Can Elliot ask a question, because I just feel bad skunking him?
No, he's not a paying customer, let's start back. Go ahead.
I just had a quick question on that, Elliot, apologize. I agree, I mean, anyone with a Bloomberg or a Yahoo, finance can see multiples, and that, affects what these businesses are worth, but how do you go about it when multiples in general are so affected by market risk? You almost have to become an economist to figure out where it's going. So how does that affect your point of view on one single one?
Can you be more specific?
Sure, like let's say I'm looking at Apple and it's worth X times, but in a downside scenario, it's worth 7 times. How do you figure out the catalyst of that possibly happening?
Yeah, let me frame it slightly differently. I think that multiple correlation is incredibly high.
Okay.
So therefore, there's this inherent market risk that if the market decides to reprice risky assets, everything's going down. It doesn't matter how variant your perception is. And so the question becomes, that seems to be more important today than ever before, at least in the modern history. How do you factor that kind of market level risk in your individual position? Is that fair?
Yeah, that's a good summary.
Yeah, look, multiples are high, and that doesn't discount from the skill set of being able to outperform the market or not, which is, I think, what we're talking about.
Well, in the long short, I agree, but maybe long only, you're forced to, and you're confined.
I think you really are forced to take market risk. We're in an environment, whether it's post QE 13 or whatever we're in, where rates are zero, there's an enormous amount of liquidity, people are scrambling for yield everywhere. You're forced to take inherently more risk in your portfolio. I think that's just a given. I think what Noah's saying is they're trying to look for pockets where they can be away from that, where something is mispriced because of misperception. Anticipate where moves are going to be. But I suspect they're using their short book to give some market, reduce some of the market exposure. And you don't do any overlays or anything like that, derivatives or option positions from a hedging perspective? Just your shorts or the...
We've done some overlays, but it's all relative. Like I've made more money on 20 stocks with a 20 PE than I have on stocks with a 15 PE. So I think that I would answer in that vein, in that which if you have to be invested, the multiples relative to each other, I think is what can create riskiness or potential opportunities.
But the simple answer is if you're long, you've got market risk these days because of valuation. Yes, sir.
With the rise of passive investing, do you think that will create more inefficiencies in the market for
No.
investors?
No.
I love that question. And people ask me all the time if like ETFs are gonna put me out of business, and I think Paul Sonkin might think that we're all gonna become passive one day. But
No, I think you can go, well, first off, passive investing isn't really passive. In index investing, like that is truly passive. Because if you have an algorithm that's smart beta, where I don't know why they don't call it dumb beta, because it isn't making
Doesn't sell as
decisions.
well.
Yeah, but it's still like it's buying and selling depending on some underlying metrics. That's not passive. That's more like autopilot. But I think that you could go up to indexation of, I was at a conference the other day. Charlie Ellis said he thought that you can go to 90% passive in index and still have an efficient market. I don't think it's that high, but I think we can go well above 50.
yeah, I think as passive becomes a bigger, or indices become a bigger part of the market, people that are doing their bottoms-up research, they should be able to capitalize on these opportunities. It goes back to what Benjamin Graham says, is let the market serve you, not guide you. So, you know, if you look at retail stocks in any given day, with the XRT being down, you'll see all the retailers down. And with the XRT up, you'll see all the retailers being up. So if you could do your bottoms-up research on Dollar General, and you know that this stock, its fair value is 95, and you know, it goes from 70 to 65 because retail is under pressure, that'll provide opportunities. But you have to do the bottoms-up work and not be swayed by the day-to-day moves. I think it'll for those that are still doing active management on a bottoms-up basis, I think it'll make it easier over time.
Go ahead.
Just one point, I agree with you 100% on the value of more momentum stocks versus the value stocks these days, because I think with the informational catalyst we have nowadays, it's made getting out in front and recognizing the catalyst in the future is going to make people money. I look at your model, to be frank, I look at information, I look at execution. I think that's about 10% of the variable. To me, it's analytic. And to me, it's analytic of 90% in terms of getting ahead of the curve. And the gentleman, we were chatting about multiples. To me, you can sit there and say, well, multiples are understood and they're out there and they're on Bloomberg. I say baloney. Bloomberg has a ton of information that's put out there by people who don't know what they're talking about. You take the best stocks on Wall Street,
As
usually a
opposed to the rest
third.
of Wall Street?
Excuse me? Multiples can be very misunderstood, especially the way they're bantied about in the popular press. Is it a trailing? Is it a current? Is it a future multiple? And to me, the most powerful multiple is the future multiple. And that is what you're trying to decipher through your analytics. And to me, analytics are the key. That's the human element versus the robot. That's doing your homework, and that's understanding where the company is really going.
We don't disagree with you. I think that you would find that we're trying to set, now partially our audience is slightly different than you. We're trying to really relate this to the pieces, information processing, execution, or incorporation. However, we do think the information dissemination is more available today than ever before, and maybe even overwhelming. So we do think at the end of the day, the Michael Prices, the Mario Gabellis, they outperform because of their analytical models. But keep in mind, the analytical model, as Noah did in his example, the analytical model changes the information you want. So he starts to look at Liberty Global slightly differently than the market. He goes out and he looks at different, he may even look at public information, but it influences the information that he goes and gets. So this notion that, oh, the information out there, he's just doing analytical is a little bit, now we pulled the hair apart, but it gets pulled back in. However, you say all of that, I put this up because we've been spending most of our time on chapter 5, which we did. There's a couple more chapters in the book, which we think are interesting. And chapter 6, where we talk about wisdom of the crowds, bad news is that you don't need many people to get an efficiently priced stock. It's shocking, and we do some experiments in school, we do some stuff we talked about, some of the things we show in the book. It's shocking. So this sort of notion that the edge is analytical, I agree with you. The idea that analytical is something you can do consistently well over a portfolio of names, that I would challenge you on. This market is highly competitive. Whether you want to call it efficient or not, it's highly competitive. Because guess what? There are other people a lot like you doing the same thing.
No, that's why I mentioned analytical is key, because you are, by doing your homework, understanding the qualitative differences between each company. You look at semiconductors, you look at a relative multiple on a semiconductor stock and say, oh, based on multiple, it's cheap, it's expensive. Baloney. Each semiconductor company has a niche, has a product, has a target market, and that target market has targeted rates of growth. And the affirmation of that strategy is each quarter. And that is what dictates where the stock will go and ultimately the success the company will have. I agree?
I agree with you. I agree with you. The problem is the market's pretty good at that. And it's hard to beat.
Like, for example, if there's a stock that historically, let's say is a perfect market, it always trades at a P of 15 times, and right now it's trading at 20 times, to me, that doesn't say this stock is too expensive. To me, that says consensus thinks that earnings are too low by 30, by a third, essentially. And that's what I mean by that.
And that earnings will go up and surprise on the upside.
Yes, but to make money on that stock, now I have to decide if earnings will go up by more than a third that's already priced in.
There was once a professor named Wayne Gretzky.
Exactly.
He was asked what he did best. He's a modest guy. At first he deferred. When pressed, he said, well, if I had one talent, I skated to where the puck was going to be.
Actually, it was his father that said that. He didn't say that, because one of the things that we did in the book
I
is
always
we
heard it was Wayne.
traced all of these, we traced
This
all these
is a-
quotes down,
you
and people
Just
misquote things
opened a
all the
door
time.
that you didn't want to. No, you'd be shocked.
But it's hard when you don't play hockey.
It was Wayne Gretzky's
so-
father that said that. So, but,
And we chased weird quotes
yeah.
to the end until we were convinced. They said, yes, sir, hand up.
Curious what topic or chapter you debated and decided to exclude amongst you two?
Well, the one that we excluded was the chapter for C-level executives.